All right, welcome to this explainer. We're staring down a serious tectonic shift looming over our economy, and today, we're arming you with a definitive protocol to survive it. Whether you're a high net worth investor, a retail saver, or honestly just someone fiercely focused on keeping what's yours, you're exactly where you need to be. We're tuning out all that daily financial noise, and we're looking strictly at the hard data to map out a very specific collision course. Now, when you examine the economic bedrock of historical market crashes right alongside our current system, the cracks look remarkably similar. Seriously, we're talking about massive overleverage in the shadow banking sector, historically unprecedented debt-to-GDP ratios, and a level of speculative euphoria that perfectly mirrors the exuberance we saw just before 1929 and 2007. These vulnerabilities aren't exactly new. They're echoes of past systemic failures, vibrating right through our modernized financial system. You know that famous quote often attributed to Mark Twain, "History does not repeat, but it often rhymes." Well, that's exactly the lens we need to use right now. We're standing on the precipice of a massive shift driven by familiar, repeating credit cycles. Sure, the specific players and the underlying tech might change from decade to decade, but human psychology, greed, and the sheer mechanics of a market pushing way past its breaking point, they rhyme perfectly with the past. Phase 1, the catalyst. Why 2026? So the danger really accelerates as we approach 2026, because we're introducing a hyper-volatile new variable into the mix, the bursting of the tech and AI bubble. Right now, literally hundreds of billions of dollars are aggressively chasing AI returns. But here's the problem. That massive capital expenditure hasn't actually materialized into proportionate corporate earnings yet. It's pure speculative momentum. So when this variable hits its absolute peak, and those earnings inevitably fail to justify the sky-high valuations, the contraction is going to send a massive shockwave through the broader market. That pop is the defining catalyst of the 2026 crash.
But listen, preparation defeats panic. You absolutely don't have to be a victim here. To shield and actually grow your wealth, there's a clear 5-step survival protocol. Physical precious metals, high-yield cash reserves, recession-proof defensive stocks, short-term government bonds, and strategic real estate. Let's break down exactly how each one of these functions in a crisis.
Safe Haven 1, physical precious metals. In a highly connected, completely digitized financial world, it's so easy to forget that almost everything you own is essentially a digital IOU. Physical gold and silver, they function as essential wealth insurance because they eliminate something called counterparty risk. They're one of the only financial assets in the world that aren't simultaneously someone else's liability. When market mechanisms break down, humanity always returns to what's held undisputed value for thousands of years. Holding a physical allocation means holding an asset that mathematically cannot go to zero. Period. Safe Haven 2, high-yield cash reserves. Now, during periods of high inflation, a lot of investors assume that holding cash is a huge mistake, but you've got to understand the concept of dry powder. Cash is absolutely not trash in a severe downturn. It's your ultimate weapon when liquidity dries up. Just think about how institutions like Berkshire Hathaway pile up record cash reserves right before market downturns. Warren Buffett doesn't sit in cash because he likes losing to inflation, right? He does it so he holds the power when a crash hits. When asset prices plummet and everyone else is desperately liquidating, your dry powder allows you to step in and buy premium assets on sale.
Safe Haven 3, recession-proof defensive stocks.
Okay, so we're shifting from cash and metals into equities now, but we're moving entirely away from that volatile tech sector. We're looking at defensive positions driven by the economic concept of inelastic demand. Think about it practically for a second. No matter how deep a recession gets, people still need to buy groceries, they still need to wash, and they absolutely still need their prescription medicine. Consumers are going to buy these items regardless of price hikes or rising unemployment. Companies that provide these baseline human necessities maintain their pricing power, and that represents a formidable shield for your portfolio when discretionary spending just evaporates.
Safe Haven 4, short-term government bonds.
Think of the financial system in terms of a casino versus the house. The equity market, especially fueled by this current AI bubble, is a chaotic casino filled with intense speculation and extreme volatility. But short-term government bonds, like Treasury bills, they represent the house, and as we all know, the house always wins. When risk peaks, the wise investor simply steps off the casino floor and moves their capital to the house, securing stability and earning a reliable, guaranteed yield while completely sidestepping all that broader market chaos. Safe Haven 5, strategic real estate. Now, real estate is fundamentally a fantastic capital preservation tool, but as we look toward 2026, you can't just buy property blindly. You need a highly surgical approach. Broad commercial real estate, specifically those over-leveraged downtown office spaces, are facing massive existential headwinds right now. So a surgical strategy means avoiding those traps completely and targeting specific residential multifamily units in high-growth demographic corridors. By focusing on essential housing in resilient geographies, real estate acts as an incredibly powerful tangible hedge against market volatility.
Conclusion: the wealth transfer strategy.
All right, the protocol we just walked through, it isn't about hiding in a bunker. It's about positioning yourself for monumental financial opportunity. You need to adopt this mindset immediately. Do not fear the crash. Prepare for the pivot. If you have your physical metals securing your base, your defensive stocks holding steady, and your dry powder ready to deploy, you aren't fearing the 2026 catalyst. You're simply waiting for the absolute optimal moment to pivot your capital back into severely undervalued growth assets.
Historical data proves over and over again that maximum chaos is exactly when the largest, most life-changing wealth transfers take place. Think back to the ashes of 1929. The generational fortunes built during that era weren't made by those who panicked. They were solidified by patient capital, investors who preserved their wealth going into the crash and then confidently bought up bankrupt businesses and prime real estate for absolute pennies on the dollar during the peak of the panic. Maximum fear creates maximum discount. So I'm going to leave you with this final, provocative thought to consider as you architect your own portfolio for the inevitable 2026 pivot. Will you be a victim of the chaos, caught totally off guard when the AI bubble bursts? Or will you implement this protocol today, preserve your hard-earned capital, and position yourself to be a primary beneficiary of the greatest wealth transfer of our generation? The blueprints are in your hands.